G'day there, ladies and gents. Mark Wallace here from Econisis. Hope you're all doing well here today. It is the first week of June 2023 and my second video here for the week after the announcement yesterday at the time of this recording of the RBA increasing interest rates to 4.1%. In asset value adjusted terms, the highest interest rate ever inflicted upon the Australian economy. And to put it in context, going back to the 1980s peak of 17%, this is the equivalent of a 38% interest rate, or 38% interest rate. Cash rate with the RBA. So, those asset values having increased 14-fold, while incomes increased only 5-fold since the late 1970s, has resulted in the baby boomers mostly dealing with sub 1% interest rates for most of their wealth generation period, if you look at it within a modern context. So, if you ever hear people talking about how bad interest rates were back in their days, no, that's not true. In a modern context, it's basically been free money for most of the past 30 years. But we're in a very different world at the moment, and we'll talk a little about that intergenerational wealth inequality in another video. But today, I want to talk about the fact that inflation continues to be very sticky. We saw inflation go up despite successive and significant interest rate increases over the last 12 months. And that really reflects or raises a question as to, does monetary policy through interest rates actually even work anymore? Is monetary policy useless against the current inflationary environment? And to understand that, you need to understand where the sources of inflation are coming from. Generally, there are two sources: supply and demand. Supply is where the inputs to production are increasing in cost due to a range of external factors, as well as businesses and corporations increasing their prices in order to increase their profits. On the flip side, you also have demand side, which is where the purchasing power of the end demand, usually households, but also other businesses, increases, and this drives prices up, with demand increasing and growing at a faster rate than productive capacity of the economy. Now, traditionally, monetary policy has been formed within a relatively self-contained economic environment in which demand has been the primary driver of inflationary pressures. But we're not in that environment anymore. We are in an environment in which the majority of inflationary pressures are in fact being yielded on the supply side, either through business profiteering, which the Australia Institute just recently did a piece on that was caused a lot of kerfuffle in the media and amongst some conservative economists, basically blaming a large share of the current inflationary environment on corporate profiteering, but also in the supply side when it comes to global factors. And that's actually what I want to talk about particularly today, which is the fact that if you look at inflationary pressures, what we're going through at the moment in Australia is not dissimilar to what a lot of other parts of the world are going through, particularly when you look at other parts of Europe and other parts of globally exposed economies. The US is actually probably doing the best as part of compared to a lot of other countries, but that's because they've got such a large internal economy and are much more resource self-sufficient and actually less globally exposed to their domestic economy than Australia is, which is very globally exposed. So when you have countries around the world sharing inflationary pressures, that's usually due to either they're having concurrent impacts from similarly implemented domestic policies, and there's definitely an overhang here from COVID and some of the expansionary policies put in place to keep the economy going during that period of time. But the vast majority of the inflationary pressures we're seeing at the moment are due to supply-side global factors, either the breakdown of supply chains that are linked to China and the increasing uncertainty, unreliability of those, as well as supply coming out of major food as well as energy supplies from Russia and parts of Eastern Europe due to the uncertainty created through the Ukraine war, but also due to the fact that there is a big push at the moment to onshore a bunch of supply chains, critical metals and other activities back into the Australian economy as well as into the US economy through the Inflation Reduction Act, and that is meaning that there's a bunch of productive capacity that's needing to be built in those countries that were previously offshored to places like China. So the problem with interest rates is that interest rates do nothing to impact those. Their monetary policy is useless when it comes to impacting global supply-side inflationary pressures because it's not being driven by domestic factors. So at the moment, what we have is the RBA effectively throwing good money after bad by implementing an increasingly harsh monetary policy on the demand side, which is already relatively soft in Australia. It wasn't a booming economy in Australia. Wages have normalized, but they've normalized back to what they were pre-2012 levels. I think people have just gotten used to wages being really low because of a low inflationary environment and the previous government's suppression policies. But we're actually in wage growth rates that are pretty normal in a historical perspective. And the economy, apart from the housing market, which has absolutely been a driver of it, most of the inflationary pressures have been coming on the demand side. And so, really, the only way that this could be seen as having any sort of real inflationary impact is by the RBA attempting to effectively tank the housing market, to take all the steam and potentially even push prices back down another 20%, to realign some prices with some wage and wealth positions and purchasing power within the economy and the households sector, which is definitely decoupled. But apart from that, in terms of inflationary pressures coming from general household spending, it's not there, and increasing interest rates is just going to increase the chances of us having a recession over the next 12 months, and I put that at more than 50% chance now. What that means, however, is that if we do have a recession, inflation is still going to be at above 5%, so we're going to have a stagflation environment, because the RBA, in my opinion, it's not that they've misread this, it's just that they've decided they've got no other tools. They're just going to keep running monetary policy until something happens, because at the moment, it's doing absolutely nothing. Inflation is sticky because it's driven by global supply side factors, not by domestic demand side factors. And the only tool that the RBA has to actually impact inflation and bring it down is domestic demand side impacts through interest rates. So they basically don't have anything to do. They're out of the game, and unfortunately, they just seem to continue to keep doing what they're doing because they've got no other tools and no other way out of this inflation. They've got no pathway to get us out of this inflationary environment. So a bit of bad news, both in terms of the intransigence and seeming illogicalness of the RBA, but also in terms of the fact that we're going to be in a higher inflation environment now, at least for a number of years, due to those global supply chain issues. But that's it for today, ladies and gents. Have a great weekend coming up, and I'll see you in a video coming up soon.